We're going to go ahead and try to get started with the program this afternoon. I know you guys are all ready to rush back to work, and we got some folks here from Raleigh, and I know they want to beat the traffic, so maybe they hopefully don't have to go back to work. So I take it that all of you didn't have enough doom and gloom in your life, so you wanted to take a moment to come eat lunch with me and get some more doom and gloom about the credit markets, right? Is that why everybody's here today? Yes, sir. Okay, more doom and gloom. Okay. Real quickly, just to get, because I know that we got sort of a varied audience. It seems like we've got some people here that are in real estate, some people here that are in finance, and some people here from the banks as well. So just to be fair to everyone, I want to start with sort of a background on what's going on. So this may be repetitive for some of you guys that are from the banking business. At Wharton Gladden & Company, essentially what we do is we work with developers, we work with real estate investors, and we also work with business owners to help them secure debt as well as equity to finance commercial real estate projects. And two specific ways that we've secured debt in the past has been through CMBS and through CDOs. And that's an acronym. CMBS is an acronym for Commercial Mortgage-Backed Securities, and CDO is an acronym for Collateralized Debt Obligations. And essentially what happens is originators like our group, along with originators all around the country, we originate many, many loans, and then those loans are going to a warehouse line with a conduit. And after that level reaches a certain amount, let's say $1 billion, all those loans are securitized, and then they're sold in the open market as a bond. And that's where you hear the term CMBS bonds or CDO bonds. There is a fine nuance between the two that you normally don't hear talked about as much. CDOs are actively managed. So what that means is they have a portfolio manager that oversees all the collateral. So in other words, this portfolio manager can actually remove or insert pieces of collateral as they see fit in order to manage the performance of the bond. So a CDO could have varying pieces of collateral inside of it. It could have residential mortgages, it could have commercial mortgages, it could have asset-backed securities, but it could also have mezzanine debt. So there's a lot of different types of collateral that can go into a collateralized debt obligation. A CMBS, on the other hand, a CMBS bond is a little more static. It's all commercial mortgages. So once those commercial mortgages are originated, they're then rated by a rating company, securitized, and then sold as a bond in the open market. And that bond is static. There's a loan servicer that basically collects payments as those principal and interest payments flow in, and they make sure the investors that have bought those bonds receive their principal and interest flow. So there's fine nuances between a CDO and a CMBS loan. And CMBS is a little older than CDOs as well. CMBS originated in the early 90s, and CDOs really started to gain a lot of popularity here in the early 2000s. So we actually started doing some CDO loans ourselves probably in the late 05 going into 06. But we've always predominantly done a lot of CMBS, at least up until last year, and then I'll talk to you a little bit about why that's changed. The predominant buyers or the predominant investors of CDOs in the past have been what we call SIVs. So in case you don't have enough acronyms to keep up with, I'm going to throw another one at you. SIV is an acronym for Structured Investment Vehicle. And essentially what they do, they're basically off-balance sheet entities. And what they do is they issue commercial paper in the money markets. They then take that funding and then they go buy CDOs. Now, for some of you that are not in finance or you're not in the banking business, you may not have picked up on that, but that's a flawed strategy in itself. In investing one-on-one, what you learn is you don't use short-term capital to buy long-term assets. So essentially that's what these SIVs were doing. But the strategy does work well as long as the money markets remain liquid. So in other words, as long as I can go back to Joe here and say, hey Joe, I need $10, and he's willing to continue to lend me that money on a short-term basis, and I'm taking his money and buying something long-term or either loaning it out on a long-term basis, well, that strategy will continue to work because you have to constantly refinance your debt in order to stay funded. Well, what started to happen in 2006 is that we started to record defaults on subprime mortgages. And these subprime mortgages were securing the CDOs. So as those defaults started to rise, you had investors in the money markets that started to say, well, hey, why would I continue to fund a structured investment vehicle if I'm not sure if his assets are still valued at what they're telling me they should be valued at? So as we progressed along, what you've seen over the summer of '07 was a problem that actually started in 2006 because defaults on subprime mortgages started to rise in 2006. The problem continued to persist, and then that's when you've seen the actual credit crisis that we ran into in the summer of '07. And I remember quite well, I actually had a loan that was closing on August the 9th, or on or about August the 9th, and my loan was completely repriced. My borrower's interest rate went up probably another 75 basis points overnight, and he had to come up with about $50,000 on a margin call to hold his rate lock. Fortunately enough, we still closed that loan. I still scratch my head sometimes and wonder how we were able to make it through that one. But in a sense, what we saw happen is last year, outstanding commercial paper, which is the paper that these SIVs were issuing in order to raise their funding, outstanding commercial paper fell from $1.2 trillion in August to about $763 billion in December. So that's quite a drop. And that was mainly because you had all these investors that started to exit the market. CDO originations were around $30 billion in 2007, and the estimated volume for 2008 is 1/3 of that at $10 billion. So that sort of gives you an idea of the type of pressure that's still in the CDO market. Now, as the fear began to grow throughout the financial system, we also started to see a rise in spreads on CMBS bonds. Spreads on quality commercial mortgages in the first half of 2007 were around 100 to 130 basis points over the 10-year Treasury, and then that increased to about 250 to 300 basis points by the end of 2007. That's quite a difference. I mean, we're talking about going from about 100 to 130 over to 250 to 300 over. So a lot of the deals that were in the pipeline were not working out because basically your rate had almost, your spread had doubled, which obviously added a lot of pressure to your monthly debt service. And we do think spreads are going to remain fairly high in 2008, as it's going to take CMBS lenders a little bit of time to get back into the market. Now, you know, one of the things that I want to point out is, remember I said before, CMBS loans or CMBS bonds and then CDOs are dramatically different. CDOs are active. They're actively managed, which means you have different pieces of collateral, like subprime mortgages. CMBS is static, so it's all commercial mortgages, and the different pieces of collateral cannot be removed, or there's no new collateral that can be inserted into those bonds. But you know, that difference didn't make any difference to investors on the back end at all. They didn't notice that. They didn't see that. All they saw was, hey, we see trouble in the credit markets, and we're hitting the sidelines. Now, defaults in the CMBS market have remained below 1%, which is a historical low. So the demand for higher spreads from investors in the CMBS bond market are not being driven by any weakness in property fundamentals. Most reported defaults are on loans originated in 2006, when our underwriting standards were way weaker than what they are right now. You know, I heard Ellen say earlier that the commercial real estate market is still doing very well. And it is still doing very well. But from the credit market perspective, they're not seeing that. They're just focusing on the fact that, hey, we've got rising defaults on subprime mortgages, and we're getting out of the market. We're sitting on the sidelines until a lot of this stuff starts to calm down. You know, one of the biggest questions I get, you know, I do a radio show every week on Tuesday on 97.1, so shameless plug, if you haven't listened, make sure you check that out on Tuesday. But one of the biggest questions I always get is, are we in recession? Or are we going into recession? And the reality is that we are in a mild recession, but there are some forces that are moderating the slowing in the economic growth. The weakening of our currency against other major currencies in the world has resulted in an increase for our United States exports, which has helped to prop up our GDP in the wake of a housing crisis and the subsequent slowdown in residential construction. The dollar has declined nearly 25% since 2002, and we estimate continued weakness throughout the first half of 2008 as a result of less available structured fixed income products, which were dominated by the issuance of bonds that were backed by residential and commercial mortgages. So in other words, we had a lot of foreign investors that were also buying these same bonds that we generated. I mean, 50% of CMBS bonds that we created were actually sold in Europe. So now that they don't have as many options as far as putting their money, they don't need as many dollars, so that's obviously causing even further weakness in our currency market.